So the MSCI World is up 20%. And that's a lot, especially after the back of the year before. In fact, we've rarely ever seen 2 consecutive years that strong. But, in the last year, it's been very concentrated, those returns. For instance, the US has delivered 90% of that outperformance. About 17.7% of that 19% has come from the US. That's extraordinary. But more than that, the top 10 names have delivered about half that performance. The average stock, on the other hand, it's actually only done about 8%. And maybe half those stocks a little under half have lost money. So the index actually hasn't done as well as it looks like, or most companies have not done as well. I don't know how you feel about that and what you've seen on.
I've seen it with other quality value managers in the same position, but we've been basically underweight US, underweight tech for a few years now. And the reason is our process was telling us that the opportunity set from a valuation and a risk-adjusted return is outside tech, outside the US. And in retrospect, we were obviously too early, but we always stick to our process. And the areas where we've been allocating capital has not done as well, and for understandable reasons, because I think the global economy hasn't been doing actually exceptionally well the past couple of years. And that's why the returns have been so skewed. But we know from history that when you have a situation where returns are skewed so much, or as much as they have now, it doesn't continue on for very long. So I think that's the thing that keeps me extremely optimistic about the next couple of years, because I do think that these things do tend to change, and when they do, they tend to change quickly.
Well, it has been something of a consensus trade, US and tech. And the trouble with that is it means everyone jumps on that bandwagon, and that sort of draws capital from everyone else.
Yeah.
All the other stocks and all the other equities, European equities, non-tech,
yeah,
capital rotates out of them into that.